Welcome back to Unfoolish Investing, everybody. I'm here in surprise.
Back from the dead. Well, see on my screen, I'm over here, so I don't.
Victor and Larry back in the house, Unfoolish Investors. We are here today to cut through the noise and get to the heart of what actually works in investing, right? And today we're diving into a hot topic. It's a hot topic because CNBC recently posted an article about it, and it came from Morgan Stanley. And what is it about? The so-called end of the set it and forget it investing strategy. CNBC, Morgan Stanley, and other financial institutions are telling you it's time to rethink your passive investing approach. What? But is that really true? Or is this just another way for Wall Street to convince you, unfoolish investors, that you need their expert guidance so they can collect more fees? Let's break it down. What do you think, Larry?
I mean, I personally think it's ridiculous. I'll just get that out of the gate. I don't think something has changed in the market in the last, however long, that all of a sudden we all need to have professionally managed portfolios to beat the market. I also don't think people should try to beat the market. I think the bulk of, fit into a bucket where they just want to be passive investors and go into that S&P 500, the NASDAQ, Berkshire, and then maybe some individual stocks on the side.
So let me ask you, did you read the article where it stated that Lisa Chalet from Morgan Stanley, which, to give her credit, she is their chief investment officer, so she's doing something right in life. Way to go, Lisa. Declared that set it and forget it was done because she believes we're entering a so-called great normalization. I don't know what's normalizing, but for me, I think it's insanity. But the argument that she's saying is after a 2-year bull run where the S&P 500 soared 70%, investors can no longer count on broad index funds to carry them to success. What?
Yeah, I mean, I guess I kind of get what she's saying, where she's saying that the market's been buoyed by the huge tech stocks for the past number of years, but I don't think that means that you can't be a index investor and still do well. I don't think those two things are mutually exclusive.
I'd agree. And here's the question I pose to you, Larry. Who benefits from that shift?
The fund managers that want you to be in their accounts and they can put you in whatever they put you in for whatever fee they charge.
Amen.
As opposed to the index investing, which is very low fee for them.
Correct. It's not a single unfoolish investor out there. It's not any average investor that's currently putting money into index funds. I mean, for me, it's strictly about how can they find ways to get themselves higher fees and better commissions. It's a money grab, and, I'm not sure I can trust Morgan Stanley with my money pushing a narrative like that. I feel like they should be pro set it and forget it, but we can also offer this over here. So let me ask you, let's take a step back, right? In your opinion, why has set it and forget it worked so well in the past?
It's just the whole market was doing well or has done well historically for decades. I think more recently, the market has done well, but it's been concentrated in a handful of stocks. And I don't think that's been the case historically.
What would you say currently, as of today, the annual return on the S&P 500?
Forever, like going back?
Yeah, nearly a century. We'll go back nearly a century. That's right. Way back.
I'm going to guess like 12 to 14%.
Woo! You're going high.
That would be my guess.
10%.
Okay.
10%. 10% over roughly the century. And again, there have been ups and downs. but long-term investors that the Unfoolish community is, who have stuck to index funds and reinvested dividends, have consistently come out ahead. And, I just feel like that brings us to question number 2. In your opinion, or what's your view on market timing? I feel like it's a losing game.
Yeah, I think it's, you and I have both said we'd rather have time in the market versus timing the market, which is, the strategy I use because especially lately, like the last couple of years, if you tried to time, especially buying like an index fund, there was really no good time to buy except whatever you had already bought because the market's just been going up, 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 up. And then it's like a self-fulfilling prophecy almost where you're like, all right, it went up, so I'm just going to keep holding until it goes down. And then, you're like, all right, I haven't invested in 2 years. I missed out on 70% gains. So just buy whatever the market's at. If you do it in a routine interval, you will come out ahead in the long run.
Preach it. Preach it, Larry. It's good to have you back. I mean, I wouldn't have put it that eloquently. I would have been like, what? But I really feel like studies show that if you're trying to time the market and you miss that 1 or 2 days over the course of the year that the market just blows up and goes up, or even, you miss 10 to 20 of them over the course of a decade, your returns are going to be impacted. And again, that brings us back to what we've always said. It's, time in the market, not timing the market. And again, that brings us to question number 3. I firmly believe that passive investing beats most active markets and most active investors. What are your thoughts?
I totally agree. The market managers, there's a reason they call it trading. It's not investing. They're in and out of stocks so fast that they're making, a couple percent here, a couple percent there, and they make their money on the volume of trades. And, 1 or 2%, 40 or 50 times, you've doubled your money.
And I'll throw out one, if you don't mind me jumping in here for a second. Kathy Wood. You know Kathy, right?
I do.
You guys go out to dinner often?
We had dinner last week, yep.
That's awesome. She, with the ARK Invest funds, made her name because she picked some stocks and they blew up. But recently I was reviewing the numbers because I was kind of curious. What has she done over the last 3 to 4 years? And her average return over the last 3 to 4 years, I think, is somewhere between 4 to 6%.
Yeah, not great. Yeah.
4 to 6%. And for me, I'm like, hold it. So the S&P, had you just put that money into the VOO, you would have had, what, 25, 26%? So you would have had 20% better gains by just going into...
Yeah, per year.
Per year. Yeah, and it's like, what's going on? Why would I want to risk somebody's opinion versus just going with something that is stable, secure, and has been known over a century to give me at minimum 10% annual returns? Yeah, maybe I don't get that 20 to 25%. That's okay. Because if you're in the market for the long term, 10% annually, that's a lot of money.
Pretty good.
That's a lot of money. And it brings us to the last point. And that to me is compounding rewards patience. 10%. But every time you jump in and out of investments like these money managers are doing, and they're like, oh, I'm in this stock, I'm out of this stock, you risk losing money. And you risk paying taxes. You don't know if you're timing the market right.
Yeah. Yeah, I mean, my personal strategy, and I'm not giving anybody personalized advice here, I'm telling you what I do, is, if I have a stock that blows up and I'm like, okay, I'm gonna cut back. I'm generally not spinning that off into another stock, another individual stock that I think's going to blow up. I'll take my profits, whatever I take out. Say I cut my position in Nvidia by half. I'm probably putting most of that in an index fund. Like,
Did
okay, I
you?
made
Is
my
this a? Is this a? Did you just cut your Nvidia
I did
investment in
not.
half?
I did not. This is a hypothetical example. I did not. This is purely hypothetical example. I'm probably holding Nvidia to zero at this point, or 500. Who knows? So yeah, like I'm not taking it and trying to take my huge win and gamble it on one stock, because that's what that is it's kind of gambling. I'm putting it in an index fund. I'm not expecting my, however many percent return that I had on the individual stock to be replicated by the overall market return, but it's much safer. I can leave it parked there for 20 or 30 years, and, you're going to get that 8, 10, 12% on average over the long term, and those smaller returns are going to compound, to your point, and be a huge, huge gain over a long period of time.
Agreed. And like one strategy that I've done that's very similar is I actually went into um, my E-Trade account and I looked at my SoFi, and I
Mm-hmm.
had my one of my earliest positions when I bought SoFi was I think like $17 and change. And it was now at $18. And had a feeling that it was going to pull back after earnings. So I ended up selling maybe a small 15% gain on my highest buy and watched it pull back. And as it pulled back into the fins, I took that money and I went back in. So now that money's still in the position, still in SoFi, but I feel like I have a better dollar cost average number than I did before because I was able to get myself out of that losing purchase from years back.
Yeah,
I thought it was
it's a good strategy, especially if you are confident in, the earnings report tipping the stock the way you think it's going to go. If your investing thesis hasn't changed and you're like, okay, the next year or two is going to be spotty perhaps, or the next 6 months is going to be spotty from an investment performance perspective, then
yeah, and I
I
mean,
get selling your high purchase price just to buy back in at a lower or dollar amount.
appreciate that. Now, why are financial institutions pushing against passive investing? I mean, for me, let's be blunt.
They don't make any money
Morgan
off it.
Yes, they're making money off of actively trading. They're moving into their higher fee funds or they're paying experts for financial advice. They don't make much from us unfoolish investors who simply park their money in a low cost index fund and just sit back and like, you know what, we're good. We're good. This is a classic example to me of Wall Street trying to move the goalposts. What's your take?
Yeah, I mean, I agree with you. They don't make much money. I don't think that they can treat money that's tied up in stocks like a bank can treat a savings account, where they can kind of invest your money while you're not using it. And then when you call on the bank to have that money ready, they've promised you that they're going to have that money. I'm not sure that stocks work that way because they have to hold the actual security. They can't just tell you they're holding the security and not actually do that. So I do think that this is, they want to make their money like they used to. Think about it this way. We got rid of trading fees. So they used to make however many dollars per trade. Most people were in professionally managed funds because stock investing was not accessible to regular everyday people. Now it is. So they have to find some other way to make money, because they lost two huge avenues of income. And not saying the banks haven't been doing well. The banks have been doing fantastic for basically since they all got bailed out. Don't want to get into that.
I mean,
So I think it's
I
crazy.
yeah, I just like it's kind of like going to CNBC on a down day, right? The narrative we have right here is to create fear and uncertainty. And they're trying to push investors back into strategies that do what? Line their pockets. And it really annoys me that they spent years telling us how much passive investing works. And now once, to your point, we're all into these apps. We're all on, we don't have to pay fees to buy and sell stocks. They're trying to shift the narrative on us. It's annoying, and to me, it's bad marketing. If you could show me the data. But the data says passive investing works. Passive investing works.
Yeah.
There's no data that shows passive investing doesn't work.
Yep. Yeah, I don't.
I talked to one person. It was like that. Because you get calls from financial advisors all the time. What's the one question you always ask the financial advisor when they call you?
What are their fees? How do they make money?
Are you a millionaire?
Okay, yeah.
If you're not a millionaire, I don't want to talk to you. I'm going back to my passive investing.
Yeah. Strategy. I don't even care about if they're a millionaire, because they could have made that money off of other people, and those people could have lost money at this person's expense.
100%. And the only thing I'll add into that is never pay a percentage. Ever. Never pay a percentage. If someone's looking for financial advice, always want a flat rate. Never a percentage.
Yeah. Well, yeah, because then you're lending yourself to higher risk investments, because, if you're up 1,000%, 5 or 6% of 1,000% is way more than, 5 or 6 of 10%.
So let's talk about a game plan for 2025, right?
Yeah.
6 steps that can help unfoolish investors around the world. We know you're out there. Be successful. And step 1 to me is ignore the noise.
Yeah. I agree with ignore the noise. I would even take it a step further and say do the reverse of what the noise is. To me, if we're all gloom and doom, the economy's been doing great the last few years. The last few years have been, if you read anything on, investing, it was, oh my God, recession, we're dead.
Where did it happen?
None of that happened.
We're still waiting for it.
On that same point, if, the market is trying to get you into an actively managed thing, I would double down on passive investing.
Amen.
And I don't mean double down like you have to invest twice as much. More of a mental recommitment. No, I'm not going to do that. I'm going to stick with what I know. It's gotten me this far to, whatever level of performance your portfolio has been doing. Hopefully it's been doing well because the overall market's been doing well. But just have that mental state of, I've gotten here because of XYZ. I'm going to stick to that.
You pretty much summed up point number 2, which was simply just keep dollar cost averaging.
Yep.
Just keep dollar cost averaging.
Just keep doing what you're doing.
Amen. Which brings us to step number 3. Diversify within reason. And what that means is, unfoolish investors, adjust your portfolio slightly. Do it thoughtfully, but don't fall into the trap of overcomplicating your investments. If you're in VOO, if you're in QQQM, right, and you want to buy a series of other stocks, by all means do it. But don't just buy one sector, because buying one sector will set you up for failure when things go bad. What you want to do is you want to diversify. Buy a little over here. Buy a little over there. Find things you love. Find things that interest you. Disney. Love Disney. Buy into Disney. Home Depot. I go shopping at Home Depot all the time, Larry. I feel like I have to own it.
Yeah, I agree with the diversification. Definitely don't want to be in one sector. You definitely want to try to avoid overlapping where you can, because you're de-diversifying, whatever the right word is for that, where you're kind of concentrating is probably the right word. You're concentrating your portfolio inadvertently. Me personally, I think there's a good potential for some small cap growth, small cap stocks to really blow up. Just because some of these mega caps have just gotten so huge. I don't think they're in any sort of trouble, but I don't think that the level of performance we've seen the last couple of years is sustainable. You're not going to get 20% every year. Get that out of your mind.
Do you know what sector I am obsessing over right now, and I'm trying to figure out what other stocks I want to complement the ones that I currently have?
Let's hear it.
Cybersecurity. Cybersecurity. I feel like what we are witnessing right now is just going to create so much turmoil, and we're going to need cybersecurity more than ever over the next 2 to 4 years. And that means if you're not in CrowdStrike, but I know you are, Larry, because so am I, you want to own CrowdStrike. I'm also looking at Cloudflare. I really want to get into Cloudflare, and I feel like I'm right there and going in. And it's looking at that sector, which I feel like is so important. What's that other company we just bought, Larry?
You're going to have to tell me.
What was it? VRNS?
Oh, Varonis. Yeah.
Varonis.
Yeah.
What do they do, Larry?
I mean, we didn't just buy them. That was a while ago.
What are they in?
Cybersecurity.
Much smaller than CrowdStrike. A lot more potential there. I personally see Varonis as an acquisition target over the next 2 to 4 years. I would not be shocked if Palo Alto, CrowdStrike, or another company that's much larger came in and just grabbed them for everything that they have. Because they're a great option. They're very small. And as the sector continues to build, we continue to see the big guys swallow the little guys.
Yep. Yeah.
Option number four. Don't chase the hype. And that means don't look at the new themes. Okay, just leave it on the side. What is that? It's Roblox? Okay, I'll take care of it after. Just close it. That was my daughter Eleanor interrupting us for Roblox popping up on our thing. Love you, El. But don't chase the hype, right? Larry was just talking about the recession that never occurred. I remember coming up through tech in the 90s, and everything was about data centers and build-outs, right? Now, everything seems to be about AI. Don't find that little AI company and be like, I need to get into you. Looking at you, SoundHound, you may be a good play, but I'm just not sure a company that doesn't make money in a sector is a good investment. Not a company that's making money and reinvesting it all into growth. A company that legitimately does not make any money, right? I find issues with. It's those things. So just don't chase the hype. What are your thoughts on the hype, Lar?
Yeah, I mean, I'm not buying. I think SoundHound is like the AI version of GameStop during COVID. Total meme stock. If you're not making money now, you're not going to be making money in 6 months and 12 months. I would stick to the proven players. Be a little more on the safe side with AI. Maybe Google, Microsoft, Nvidia if you're feeling a little gutsy at these levels.
I am not feeling gutsy. You're the gutsy one, Larry. That's why we have you here.
Yeah, I'd be buying proven. They've got the money to back it up. People really investing in AI and not just saying they're investing in AI.
Agreed. Step 5, review, but don't obsess. Again, a once-a-year portfolio checkup is fine, but you don't need to react to every news cycle. If the market says it's going down, it doesn't mean I should go in and check my portfolio to see how much I lost that day. It's irrelevant. Irrelevant. It's going to flip, and then you're going to have an update. You don't have to be constantly in and out of it. Yeah. Not unless there's a reason, not unless you're like actively buying in a particular stock and you want to make sure things are going right. But just kind of like buy into that set it and forget it strategy, knowing that the good stocks you're buying are going to do well. Don't chase the news cycles. Ignore the noise.
Yep.
What are your thoughts?
Yeah, I mean, I try to think about it like stocks go down really fast, but they tend to go up for a long time. You know, if you're looking at your stocks and they're going down really fast, all it's going to do is cause you to panic and reconsider what you're doing. And it could be that nothing's really changed with those companies. It could just be the overall, market tone has shifted. Um, so like unless something's changed fundamentally with the company, there's no reason to change your methodology at all.
Agreed, 100%. In the final step, remember who profits from active trading. Every trade you make adds up in fees, spreads, taxes, you name it. The more you trade, the more you enrich Wall Street, not yourself. And as long... Shortly, what do you need? What is it? You need the Kindle? What? I'll cut all that out. Every trade you make adds up, right? So again, we don't want to enrich Wall Street. We want to give ourselves the money, not the brokers, not the financial analysts. What's your thoughts?
Yeah, I mean, to me, like my mindset behind investing, like just the principle of investing, is to pay myself. And you want to pay yourself before you pay everyone else. At least that's my thought. I don't work to give my money to other people. I work to, you know, build my money for the things that I want in my life. So think about it like you're paying yourself, and you're not investing to give it to someone else. Unless it's like, you're investing to, build a nest egg for your children, whatever. That's different. What I mean is don't give your money away to people that are trying to make money off of you trying to make money.
Agreed. So let's recap. Step 1, ignore the noise. Step 2, keep dollar cost averaging. Step 3, diversify within reason. Step 4, don't chase the hype. Step 5, review, but don't obsess. In step 6, remember who profits from active trading. It's them,
Not you.
not you. Amen. All I can say in closing is investing should be boring to a certain extent. If your investing strategy, personally to me, is exciting and constantly changing, I feel like chances are you're doing something wrong, because wealth is built over decades, not days. What do we like to say, Larry? Time?
Time in the market beats timing the market.
Amen. The idea to me that the set it and forget it strategy is over is just absolute insanity. It's just another scare tactic to push individual investors into expensive, actively managed strategies. Unfoolish investors, we don't want that garbage. We don't want it. Don't fall for it. Stick to the fundamentals. Trust the process. And keep your eyes on the long game.
I mean, coming of age in the 90s, I'm just going to go back to Ron Popeil with the Showtime rotisserie. Set it and forget it. It's not dead. It's alive and well. Index funds are going to make you much wealthier over the long term than actively managed funds.
Preach it. That's it for today's episode of Unfoolish Investing, everybody. If you found this valuable, don't forget to hit the subscribe button and share it with someone who might need to hear it. Until next time, stay patient, stay diversified, stay unfoolish.